To everyone who's joined us today for the latest in our 50th anniversary webinar series. Just let me know if you can hear me okay. If you can hear me quite clearly, you can post a message there. So for today's webinar, we are very happy to have Professor Servaes with us, who will be discussing corporate liquidity after the financial crisis. My name is David Ratcliffe. I am the Programme Associate for our Executive Education Finance Programmes. I'm also joined by Mrs. Anne White, the Finance Programme Director, and she's going to be helping me keep a track of any questions or thoughts you might have during the webinar so that we can address them to Henri at the end. The Professor will be speaking for approximately 30 minutes, and then we'll have the time for some of your questions at the end. So do feel free to post them as you go along. Henri Servaes is the Richard Brearley Professor of Corporate Governance and Professor of Finance here at London Business School. His publications and research focus on corporate governance, IPOs, mutual funds and capital structure, and you can find all further details of his research, his numerous awards and other consulting work on his faculty profile page at the london.edu website. So the issues discussed today will be taught in length in Henri's Financial Strategies for Value Creation programme, and all details of those upcoming dates we'll post here after the talk. So without further ado, I will hand you over to Professor Henri Servaes for the webinar, What Should We Do With All Our Money?
All right, well, good afternoon, everyone. This is a topic that's quite important. You read on a daily basis about cash hoards of large corporations, and I just want to talk a little bit about how big these cash hoards are, what the real problem is associated with these cash hoards, and what can be done about them. Now, of course, you might say this is a luxury problem that not all of us have, and it is indeed true. Not every firm is sitting on tons of cash, but it does seem to be quite pervasive, and at least it's worth addressing and making some suggestions as to what the cost is of this problem and what we can do about this. So in this outline, I'll first try to tell you how severe the problem is, and then argue why there is a problem in the first place. What's the big deal about excess liquidity? And then we'll talk a bit about the options. So what should I do with that? Although I'll be relatively brief about the strategic options, and then a little bit of out-of-the-box thinking before concluding. So how severe is this cash problem? Well, I actually want to start with an observation that's not related to cash, but you will see in a second how this ties into cash holdings. What is plotted here is simply the ratio of debt to assets for companies from the US, the UK, Germany, and then just worldwide. I think there are a couple of interesting observations for looking at as to why we would be looking at debt. But so the first thing to note is that there's actually no increase in leverage, and this is perhaps not what you may think happened, because everybody seems to think that the credit crisis was due to massive debts, and that was indeed true, but not massive corporate debts. Corporations, if anything, have actually reduced their leverage to some extent, but certainly no evidence of an increase. Now I'll come to in a second why this is related to the liquidity problem. But so in terms of leverage, broadly, maybe a slight decline, but relatively flat, and certainly no run-up before the crisis. But let me now show you on the next slide what has happened to the cash holdings of corporations. So I'm simply taking the cash as a fraction of the assets of companies, and I'm plotting it over about a 25-year period. And of course, what you see is just a dramatic increase, essentially a doubling of the amount of cash that is on corporations' balance sheets. But in the US, the UK, Germany, and then worldwide, you see an increase of cash holdings from about 10, 12, 13% of their balance sheet to 20% or close to 20% in some countries. So it's actually been a massive increase in how much cash companies are holding on their balance sheet. The other thing to notice, and we'll come back to that later, is that if I were to show you this graph and I were to say, point me to when the financial crisis happened, I think it might actually be hard for you to say, oh, this is when there was a problem. You know, if you then point it out later, of course, you see that there's some decline in the amount of cash, maybe starting in 2008, 2009. But in fact, the decline in cash was quite modest, and even post-crisis, we are still having a lot more cash on balance sheets than in the periods before. And that then leads to a third observation, which I think, at least the first time I saw this, I found quite startling. If you compute net debt, so if you take the debt that corporations have and you just net off the amount of cash that they have, you come up with something that's actually very low. And in fact, in the United Kingdom, for example, it's below zero. So the average firm in the United Kingdom actually has more cash on its balance sheet than it has debt. But even for the United States, this graph touches zero. In Germany, it's very close to zero. And even worldwide, we are at net debt levels of barely above zero, really. And if you compare that to 10 years earlier or 20, 25 years earlier, you had levels of about 10%. So there has been a dramatic shift in sort of net gearing. And the other thing that might make you a little bit surprised about this is of course that interest rates are very low, cash seems to be yielding very little, and debt seems to be quite cheap. Nevertheless, what we actually see is that the amount of net debt on balance sheets has declined. Now, what are the justifications for these cash balances, right? If you ask corporations why are they doing this, and more importantly, not only do we need to be able to explain the level of cash that's on balance sheets, but also the change. Why has there been such a dramatic change in the amount of cash? And I think you essentially get perhaps four stories. Maybe you can suggest others, but you get four broad stories, which, so the first one is that you need it for a rainy day. Something bad may happen, there may be a shock, and that's where we need the cash to really help us out. And so the reason that there is more cash now than there used to be is because global uncertainty has increased. The environment has become more competitive, and so these potential rainy days may occur more often, and that's why we need more protection now. And that then ties into the second one, which is the environment is changing very rapidly, product life cycles are shorter, and so we need the cash and the flexibility to allow us to invest more or to do R&D or anything like that. The third justification comes from the M&A market, where if a good target comes along, if you're sitting on a lot of cash, you can quickly fork over the cash and buy a company, while if a competitor does not have the cash, it may take the competitor a longer time to gather the funding, and as a result may lose out on that acquisition target. So it gives flexibility in the M&A market. And then maybe the last reason that you hear is that people are now worried about what's called rollover risk. During the crisis, there were a number of companies who had debt maturing and who were essentially not able to roll over their debt because the markets at some point were simply shut down. Towards the end of 2008 or early 2009, a lot of companies were simply unable to refinance their debt. And so the corporations are saying, well, let's hold on to the cash. If the debt matures, we can just pay it off if need be, and then we can refinance it later. Now, in the next couple of minutes, what I'm going to do is I'm actually going to spend a little bit of time on each of these four arguments to see whether these actually can truly be justified, to see whether indeed they make sense, and they explain why there has been a change in the cash holding. So the rainy day, more uncertainty, rapidly changing environment. The environments are changing more rapidly now than they did 10 or 20 years ago. M&A, maybe even there are more transactions being done, so maybe again a further need to hold cash. And then finally, rollover risk, which was something that people perhaps did not appreciate before the crisis, but they appreciate more now. And so I'm going to examine these stories in just a little bit more detail, given the limited time we have, of course. So first, I want to come back to this rainy day story, right? What's the rainy day exactly that companies argue that they're buying protection for? If you were to ask me, what was the worst rainy day that happened in the recent past, I would say it was the crisis, of course. Well, let's go back a few slides and look back to slide number 5 at cash holdings over the crisis. And indeed, you see that there has been some decline in cash holdings from 2007, say, to 2009, followed by a bit of an increase again. But if you're holding your cash for a rainy day and you don't spend it during the worst crisis in generations, what is exactly the event? What is this Armageddon event that you are protecting yourself from, that you need all this cash for? Even during the crisis, companies ate up maybe 2 or 3% of their cash holdings relative to what they had before, and they quickly replenished them. And even in 2009 and 2010, the amount of cash on companies' balance sheets is basically the same or even higher than 2003, 2004, and substantially higher than what we saw in the 1990s. So I don't really buy the rainy day argument, because if the rainy day argument was really correct, I think we would have seen companies eat through a lot more of that cash during the crisis. So the other thing is that we need to move quickly in a rapidly changing environment. But I find that to be a little bit of a cheap excuse, because it's not very tangible. It's sort of, well, I don't know what's going to happen, so more is better. So 10% cash is not enough. 20% cash is not enough. 30% cash is not enough. If you make that argument, you don't actually have a proper story to tell as to why that much cash is needed. There needs to be at least an argument as to what kind of crisis might happen that would make the company eat up 10 or 20% of its cash. And if you cannot tell that story, then I think it's not quite fair. I think it's a little bit too vague. Now, I'm not saying firms shouldn't have any cash to protect against some unknown, but this has to be a little bit more reasonable, I think. So the third argument is about flexibility on the M&A market, right? You can move very quickly if you have the cash. If a company comes up for sale and you have the cash, you are very quickly able to propose an offer and make the acquisitions. In a couple of minutes, I'm going to argue, though, that there are alternatives that should certainly be considered. But of course, it's a correct argument. If you have the cash, you can spend it quickly. And in fact, when KPMG did a M&A outlook survey just a year ago, they asked companies, which factor do you think will most facilitate deal activity in 2014? And by far the most popular reason, so 25% of the respondents said large cash reserves or commitments. Right? So the fact that they sat on a lot of cash allowed them to, in their minds at least, move quicker in the acquisition market, followed by a number of other arguments, but the focus of this talk is really on the first one, on the cash. So this does seem to be a correct argument, but I'll come back to it in a second, because I think it's not entirely fair. The last argument for holding on to all this cash is that this is protection against rollover risk. So rollover risk is that your debt matures, and that for whatever reason, credit markets are very tight, or they've shut down, like during the crisis, and the firm is simply not able to roll over its debt at all. Now, of course, here rollover risk is present, and there is always some uncertainty as to whether debt can be rolled over or cannot be rolled over. The real important question here is really, it's just a matter of degree. Of course, there is some rollover risk, but does that mean that for every euro of debt that you have on your balance sheet, you need to hold a euro of cash? I mean, so what's the point? You borrow to sit on the money? It doesn't. There's just not that much of a logic. Right? Now, the other thing is, if we really think that this is a story about rollover risk, and we want to explain the time series, so we want to explain why there is more cash on balance sheets now than there was 10 or 20 years ago, then we have to argue that rollover risk has become more severe. Now, one way of measuring this is to simply look at what fraction of companies' debt matures within a certain period. And so the graph that's on slide number 9, you can just see the fraction of the debt that's due in 1 year, the fraction of debt that's due in 3 years, and the fraction of debt that's due in 5 years. And I think what you see there is that there is indeed a modest, I would argue, increase in the fraction of debt that matures very soon. So debt maturity has shortened a little bit. And if debt maturity has shortened, then there is indeed a greater rollover risk, and that might indeed justify then why firms are holding to a little bit more cash. But a couple of observations. One, of course, is that at least for 1 year and 3 year debt, this is actually tailing off post-crisis. So firms have gone more for longer term debt, probably in response to the fact that they had rollover risk. So rollover risks, there are two ways of protecting myself. Either I hold more cash, or I spread my debt maturities out a little bit more. Now, what seems to have happened is that firms are doing both. They're spreading their debt maturities out a little bit more, but they're still holding more cash. And somehow, that just doesn't make sense to me. I'm not saying that rollover risk hasn't increased. I'm not saying that it's no justification for a slight increase in cash holdings. But in my view, this is just too much. I mentioned that I was going to come back to this flexibility in the M&A market, and I think we have to be careful with this flexibility story. First of all, it is not the case that if you are poor, cash poor, that you cannot make acquisitions. If you are a listed company, then you can of course also fund acquisitions by exchanging shares. And in fact, many of the firms that are arguing that they need the cash, that the cash is particularly helpful to make acquisitions, are listed firms, and they actually have a very good alternative in terms of their funding, using shares. So they don't necessarily need the cash. In addition, of course, you can find smart ways of structuring your M&A activities. And these are, in the course that I teach, these are things we talk about in much greater detail. But you can structure your acquisition through an earn-out, where part of the payment is contingent on the future performance of the acquired firm, and as such, you don't need to come up with all the cash anyway. Another interesting observation is actually that the firms that say that they need the cash to make acquisitions are often actually firms that are not very acquisitive. I mean, you can imagine that the cash-rich firms in particular are the ones who are the highest rated firms, because they have little net debt. So they have the highest debt rating. And this graph comes from a research paper that I've just recently computed. And all we do is we rank the firms by their debt rating, and then we look at the likelihood that a firm will make an acquisition that's at least 1% of the size of the business, right? So a 1% acquisition, not very big, but that's our cutoff in this case. And so, not surprisingly, you see that the very low-rated firms, they don't make a lot of acquisitions. But then actually, you see that the maximum is at a rating of about A-, and then it tapers off dramatically. So the highest-rated firms actually don't make that many acquisitions. So the firms that say that they need the cash to be able to make a lot of acquisitions are those firms that make some of the fewest acquisitions of any of the firms around. So I find this flexibility in the M&A market argument also not entirely credible. Now you might say, okay, fine, this is where we stand. You don't believe the arguments. There is one other piece of evidence to suggest that the amount of cash on company balance sheets is excessive. And that is the fact that there is another source of liquidity. Not only do we have actual liquidity in the form of cash, but a lot of these firms also have enormous lines of credit which they can use. And here is some survey evidence. Lines of credit data is very hard to get to because firms don't have to disclose their credit lines. So there is some survey evidence, and of course I'd like to have this data post-crisis, but this is the most recent I have. But so what you see is that, this is a survey of 241 large companies, that 38% of these companies have lines of credit in excess of 20% of their assets. So on top of the enormous actual liquidity that they have, there is in addition this optional liquidity in the form of these credit lines, which, if you add the two up, gives companies liquidity in excess of half of their balance sheet. And in my view, that just cannot be healthy. Now, in a second, I'll come back to the cost of this. But the bottom line, at least my perspective on this, is that the level of cash holdings that we see on corporate balance sheets these days is very, very difficult to justify. None of the arguments that can be made, if you sort of test them against the data, none of these arguments are strong enough. And while I do not disagree with the notion that perhaps a little more cash might be merited, a doubling or a tripling of cash holdings, as we've seen in some corporations, just doesn't seem to make much sense. Now, you might say, fine, okay, so I'm convinced that there is too much cash on companies' balance sheets, but what's the big deal? Maybe there's too much cash, but what is the cost of this excess cash? What is the problem that it causes? And there, I think this does cause serious problems, but it's not of the kind that is most, what I would say most common perception. I think the common perception is the following, and you can correct me if I'm wrong or ask questions about it later, but I think the common perception goes something like this. First, cash, particularly today, of course, is not earning anything. Interest rates are very low. So that means that the firm is actually not earning the required rate of return by shareholders on its cash. It's not earning its cost of capital on the cash. It's earning a rate of return that's much lower. As a result, profitability is lower. As a result, earnings per share are lower. And as a result, the share price is lower. And I think a common perception is that this is what the real problem is with holding excess cash. Now, I fundamentally disagree that, with this argument that the cost is sort of due to just lower rates of return on the cash. And the reason is because this argument fails to make an adjustment for risk. After all, cash is a safe asset. It should earn a safe rate of return, and it would not be fair for investors to require firms to earn the same rate of return on their cash as they earn on their operating assets. There is nothing wrong with earning a lower rate of return on the cash, because if I took that cash and I put that cash in the pocket of the shareholders, then shareholders would earn the same rate of return on it. Now, there are a lot of comebacks to this. People say, yes, but I didn't invest money in a company for the company to hold cash. I invested money in a company for it to earn, a higher rate of return because I was willing to take some risk. And I agree, of course, that if you invest in a company because you want a certain risk profile, then if the company reduces the risk profile, that's not particularly, the nicest thing to do. But I don't think it's that serious of a problem. If a company is a little bit safer with its investments, that means you can actually put more of your money in that company, or you can hold less cash in the rest of your portfolio. There are ways for you as an investor to optimize your portfolio so that you can undo the effects of the cash holdings in the corporation's pocket. After all, if you put yourself in the shoes of investors now and shareholders should not be tied in terms of the risk taking in their portfolio to the specific risk that individual companies take. Investors should be able to make those decisions on their own. So I don't think that this is actually the problem associated with having too much cash. So what is the problem? Why do we care? I think the true cost of holding excess cash is actually much more severe than what the common perception is. I think the true problem of holding excess cash is that it's indicative of the wrong corporate mindset. What is the argument? I think the typical mindset that you find in quite a few corporations actually is something like this. An argument is this is our money, and by our they mean the corporation's money. So, so it's normal that we keep it, and we need to find really good justification for us to return it to our investors. And unless we can find fantastic justification for returning it to our investors, we're just not going to do so because it's our money after all. Now, I say that's the typical mindset. Of course, that's not the correct mindset. Right? The correct mindset really is that this is the investor's money. And so the company should justify every dollar that it keeps. Because unless there is good justification to keep it, it should be returned. And the problem is that if you have the wrong mindset as a corporation, then this mindset permeates to many other corporate decisions and is ultimately going to be unhealthy. So what's going to happen? I think the firm will be running the interest of the management and not necessarily of the shareholders. The management, because they have a large cash hoard, can afford to take life easy in a way. There is no particular need to be cutting costs. There is no particular need to be proactive and to think about potential things that can go wrong, because the cash is always there to back them up, right? And in some sense, cash is the ultimate risk management tool. If something goes wrong, we always have the cash to back us up, so we don't really need to do a whole lot of contingency planning. This then also leads to a lack of discipline in many other decisions. And I think one decision that you can easily observe is the decision on acquisitions. And so remember, I mentioned earlier, having a lot of cash allows you to be very flexible on the M&A market, and that seems to be the positive. But the negative associated with that is that if you're a cash-rich firm, you might be less disciplined in how much you actually pay for potential takeover targets. And in fact, that's consistent with what research indicates. Research indicates that cash-rich firms are more likely to diversify when they make acquisitions. And of course, in diversifying acquisitions, it might be much harder to find synergies. They seem to overpay when they engage in acquisitions, so they pay a higher price than other companies, and they have poor subsequent operating performance. So, it's almost like the cash is burning a hole in somebody's pocket, and the lack of discipline when you have a lot of cash then translates into the negotiations process during an M&A. And I think the lack of discipline in M&A is just the tip of the iceberg of the, and indicates a lack of discipline in a lot of other corporate decisions. And this actually shows up in what the cash is worth. If you do a typical valuation exercise, you value the company and then you see the cash on the balance sheet and you just add the cash, because you say if there is 100 pounds of cash, I value that 100 pounds of cash at 100. But actually that is not what research finds. Research finds that the value of cash very much depends on the quality of the corporate governance of the firm. And so if the governance is poor, if the managers are not running the firm with the best interest of shareholders in mind, then shareholders actually apply a discount to the cash, because the cash is not in their pockets, it's in the corporation's pocket, and it's not ring-fenced. It's not always going to be there. It may be used for poor acquisitions, for investment projects that really don't generate enough of a rate of return, etc., etc. And so research suggests, and this depends on exactly the years and the sample that you look at, but that $1 of cash is only valued at between 42 and 88 cents. So, half, or maybe on average, maybe half or a little bit over half. So in other words, capital markets assign a discount to the cash holdings of cash-rich firms simply because they don't think that the cash will ever end up back in their pockets at full face value. It will only end up back in their pockets after taking into account poor operating decisions, poor investments, lack of cost cutting, lack of discipline, and maybe poor mergers and acquisition decisions. And corporations should do something about it. I think every corporation that has maybe the luxury of having all this cash should really think carefully about why they're holding it. And if they can't tell a good story, the money really has to come out. Sometimes pressure builds from the outside, though. And this example illustrates that no company, even the largest company in the world in terms of market valuation, is not immune to this pressure, right? And so in October of last year, Carl Icahn wrote a letter to Apple and its shareholders saying, look, you have 133 billion of net cash, so cash after subtracting the debt, we think you should make a tender offer to buy your own shares back and increase the magnitude of your share repurchases. Tim Cook then said, "Oh, thank you, but we appreciate hearing from you, but we've already been giving money back, and as we've said before, we'll think about this on an annual basis, and that's it." So you sort of thought that the story was over, but less than a little over a month ago, Carl Icahn then tweeted to his followers in response to something Tim Cook had said just the day before, where Tim Cook said, "Well, my view is for cash that we don't need with some level of buffer, we really do want to give it back. We may come across as hoarders, but we're not hoarders. We are going to give it back." And so now in April, presumably there's going to be some announcement from Apple as to what they're exactly going to do with the cash. So in the end, it does seem like Carl Icahn is getting what he wants. And if Apple can be subject to that pressure, then certainly smaller companies can be too. And so then, what do? Well, the money has to come out, and there really are only two ways for firms to distribute excess cash as a going concern. One is to pay a dividend, and you can pay a regular dividend if you think that you have enough cash to service a dividend on a regular basis, or it can be a special dividend, a one-off dividend, which is a payment you make to shed a large amount of cash. For example, in 2005, after it was under a lot of pressure, Microsoft decided to pay $32 billion in one go as a special dividend to its shareholders, to relieve some of the pressure that they were too feeling because they were sitting on too much cash. Another thing you can do, of course, is to buy shares back. You can buy shares back on the open market, on the stock exchange, or you can do it through a tender offer, which was what Icahn was suggesting that Apple do. Now, there are many considerations as to how you should decide between dividends and repurchases. And in the course that I teach, Financial Strategies for Value Creation, we spend quite a long time trying to find the best combinations of dividends and share buybacks, that is optimal. And obviously, given the duration of this webinar, I don't have time to go into all of those. But I do want to make one, I think, important point, which is that buying shares back is an entirely viable option as a means of returning funds to shareholders, and really should be considered together with paying dividends. I think one important lesson is that we should not think about dividend policy or repurchases. What we really should think about as corporations is to have a payout policy, a policy aimed at paying out funds to our investors, and dividends and repurchases should be both part of that policy. Thinking of share repurchases and dividends in individual silos is not really a healthy thing to do. And buying shares back as a means of returning funds to shareholders is an entirely viable option that should indeed be considered. Now, I just have a little bit out of the box thinking. It's not going to solve the cash problems of a lot of companies, but there are actually two possibilities. One is what I would call corporate venture capital, which is corporations that are acting as venture capitalists. Corporate venture capital is becoming very big. Most large corporations, particularly on the tech side, but also on the non-tech side, have a venture capital arm that essentially is capitalized by the corporation itself, which allows it to take small positions in startup companies. And I think this is, certainly for large companies, this is something to consider. This is probably not going to make a massive dent in cash holdings. If you are going to consider acquisitions, then maybe you should also consider acquisitions of a different kind, where instead of buying a company and integrating with the existing businesses, maybe the funding can be used to buy companies run by other management teams that remain standalone. And one of the examples is where Warren Buffett really used its cash in cooperation with a private equity fund, 3G Capital, to acquire Heinz. Maybe there are other opportunities to do so. Then, of course, finally, there are exceptions. If a family firm, for example, has excess cash, then maybe it is okay for that firm to keep it in the business as long as they feel they're disciplined about it. But they may want to keep it for tax reasons or because they want to consume at the firm's expense, which might be cheaper than to first pay themselves a dividend and then consuming later. So In conclusion, I think the abundance of cash for corporations' balance sheets is really a problem, and many of the arguments that are usually provided may explain why there has been some increase in cash holdings, but the full increase, the arguments are simply not credible. And if you don't have a credible plan, then you don't have a leg to stand on in front of investors, and so then I think this leads to problems. It leads to complacency and poor decision making, and ultimately, if firms do not take action on cash holdings themselves, I think they become vulnerable to activist attacks or possibly to takeovers. And I don't think there are a lot of good alternatives beyond indeed returning the funds. So thank you very much. I hope you found this webinar useful, and I'm now happy to take any questions that you may have.
Henri, I have a couple questions that have been raised offline. How much validity do you think there is to the argument that in the case of American corporations, for example, in particular, they can often be hit by huge U.S. tax bills for repatriating offshore cash balances?
Well, for U.S. corporations, there is indeed the argument that a lot of cash that's on their balance sheet is actually what's called trapped cash, and if they were to return this to the U.S., they would be taxed quite heavily on it. However, there's good research out there showing that actually if you match U.S. firms with foreign firms based on the same characteristics, you see the same types of cash holdings in foreign firms as well, and this tax argument is very unique to the U.S. So it is not the case that U.S. firms are actually particularly cash rich relative to foreign firms. Of course, we always think about the biggest ones and the Apples and the Microsofts, but if you look at the typical firm in the U.S., even if it has cash that's abroad, it doesn't have more cash than the typical foreign firm for that matter. And of course, there is a temptation to take this offshore cash and also use it to make an offshore acquisition. For example, Skype was bought by Microsoft with offshore funds. There's nothing wrong with doing that, but that still does not justify overvalued acquisition. Now, so what's the next best alternative? If you really have trapped cash, if you really want to return funds to your shareholders, the next best alternative is to indeed borrow against it. It's a little bit what Apple is doing. Apple, you might say, why would Apple be borrowing any money? Why don't they just take the cash and pay dividends and buy shares back? And to some extent, the reason they're borrowing some money is because they can't actually use all the trapped cash. Ultimately, I think the US should change its tax laws, of course, but that's a different story.
You were talking about when management decides they don't want to increase the stock dividends or the yields. What do you think about that argument? What they say is perhaps we don't want to create a precedent. If we have to start increasing our yields, maybe some point in the future, we won't be able to sustain that dividend growth rate. And that's one reason why we don't want to keep giving out that cash out in dividends.
No, I mean, so that might well be a justification for not paying it out as a dividend. So firms that are paying dividends, regular quarterly dividends, they're setting them, they're setting a precedent. And so the argument is don't pay a regular quarterly dividend unless you can sustain it. But that's not a justification for keeping the money. So if you cannot sustain it, then pay it out as a special dividend, or pay part of it out as a special dividend, like Microsoft did in 2005, or indeed buy your shares back. So that's entirely possible.
There's a question from Jose Gonzaga. What is the percent of cash holdings invested in money market funds? Could this be an issue for asset managers if firms reverse this trend?
Well, so most of the large firms that invest their cash, they have their own money market fund in a way. They buy their own instruments and they don't invest it through money market funds. But smaller firms do to some extent use money market funds. My argument, I think it's still limited, so I don't think there would be a sort of a massive outflow of money market funds. Because it's more the smaller firms that are doing this. The larger firms, I think they've sort of bought the instruments on their own. Now, of course, if the larger firms also get rid of the cash, there will be some selling pressure on some very short-dated debt. that would lower the price of, for example, commercial paper that they're invested in, and that would slightly increase the yields, I think. But that might actually be a good thing if we get a little bit higher yield on short-dated instruments. One other point to note, Jose, is that there's now some research suggesting that this cash, which is supposed to be quite a safe investment, more and more firms are doing some things with that cash that's becoming, just a little bit riskier. For example, they're investing it in slightly longer dated instruments, which are then subject to interest rate risk. So if some of if we're going to get interest rate rises, if the cash were really invested in very short dated, money market instruments, or what we call commercial paper, it wouldn't matter. But if the cash is invested in debt that matures, say, in 1 year, then a slight rise in interest rates would actually lower the value of that cash. And so we have to be a little bit careful. So firms are actually starting to just speculate a little bit more with the cash than we like.
Henri, this is a good question from Michael Hoffner, and it makes me want to encourage you that if you come take his class, Financial Strategies for Value Creation, you're really going to have an opportunity to have Henri go into this in much more detail. Michael's question is, can you elaborate a bit more on the choice between dividend payout and share buyback?
Well, I mean, it's quite a complicated question, Michael, because there are many issues at work. But let me give you an overview of the things to think about. One of the issues is actually the one that Anne brought up in terms of permanence. So, the dividend, you have to make sure you can sustain it, because otherwise you will get punished quite severely if you start paying a dividend and you cannot then maintain it. But there are a number of other considerations. For example, taxes actually play an important role. The tax that is charged by the government on dividend payments versus the tax that investors would be paying on the capital gains if they participated in the share buyback. So one thing that you need to investigate is what the tax consequences are on your investors of doing one versus the other. A third is what we can learn as investors from these corporate actions. So a dividend will give you a more comfortable signal about the long run ability of the company to keep generating the cash, because a dividend at least comes with the expectation that it will be more or less permanent, where a share buyback really is very much a one-off. You can repeat it, but there is no promise of repeating it. So if you think that you want to send a very strong signal about future performance of the business to the market, and you feel that analysts are not well enough informed about your firm, or there are not enough analysts out there about talking about the company, or if you really think that there is a substantial gap between what you feel your company is capable of and what the market currently thinks the company is doing, then a dividend may well be the solution. In terms of a share buyback, of course, you also want to look at valuations. So, a share buyback may be of interest because you think, okay, this is better for taxes, but you have to compare that to whether you think your share price is reasonable. And you can buy your shares back if you're undervalued, you can buy your shares back if you're fairly valued, but the moment you hit overvaluation, that's when you have to pull back from the share buyback. So those are already a couple of arguments that I've outlined, but these of course require a bit more in-depth investigation.
We'll take maybe one or two more questions. Pilar Velasco wants to know, do you think a policy of holding more cash may also have contributed to preventing firms from overinvestment problems in the crisis environment with less investment opportunities?
Well, I mean, in the crisis, of course, indeed, investment opportunities dwindled. But what you find is that firms that entered the crisis with more cash holdings, of course, they weathered the crisis better. And in the crisis, overinvestment was not necessarily the problem. So, I mean, it is clear that having some cash going into the crisis helped, and I don't think that there was no overinvestment in those cases. But in general, I think cash just makes you that little bit more inclined to to spend maybe just a little more money on an investment or on a project or an acquisition than you would otherwise have. You know, it just eases the pressure a little bit on a firm.
And we'll take the last question from Daniel. Daniel Garcia asks, is there some sensibility about the ideal cash to assets ratio for large corporations?
Absolutely, Daniel. So there's very good research on there that sort of tell that there are good models that suggest, you know, give me a number of corporate characteristics and I can put them into an equation essentially, and out will come an ideal cash to assets ratio. So I cannot answer that, you know, specifically. I can't say this should be 8%. Because it very much depends on the nature of the corporation. Where the corporation is located is going to play a role, because if you're located in an emerging market, then, you know, raising new funding is going to be more difficult than if you're in a developed market. It's going to depend on how good your investment opportunities are. The better your investment opportunities, the more cash you should hold, for example, because, you know, if it, you know, an opportunity comes along, you want to be able to grab it. If you have very few investment opportunities, then there is less need to grab the opportunities when they come. Not only does it depend on so the quantity of the opportunities, but also the quality of the opportunities. So you can measure investment opportunities within an industry, for example, and that would suggest more cash holdings. Of course, leverage is going to matter. If you have a bit more debt, then maybe you can also hold a little bit more cash to protect yourself from rollover risk. So there is good work on that, and I'm happy to share some of that research with you. But so I cannot just put a number on it, because it really depends on the individual firm's characteristics.
Okay, that's all we have time for today with regard to this webinar. But thank you all very much for joining us today online. On the screen now, we're just going to get up the dates for the details of Henri's upcoming corporate finance program, the Financial Strategies for Value Creation. Now, this program is available in the 5-day intensive block week format, as well as an evening program for those of you that are based in London. If anyone would like to see more details, if you'd like to see a more detailed syllabus of what is taught on the program, do contact me. All my details are there online, just at finance@london.edu. So thank you all for attending today, and thanks for your input and questions. Do keep an eye out for our future finance webinars and events. And once again, thank you very much, Henri, for sharing your time and insights with us today.
Thank you very much.